Welcome back to the Deep Dive. Today we're plunging into a topic that impacts, well, pretty much every single one of us. Smart tax planning. You sent us a fantastic collection of articles, research, notes, all about tax optimization. And our mission today, to cut through the noise and really pull out those clever strategies, the ones that genuinely keep more of your hard-earned money in your pocket.
Yeah, we're moving beyond just, filling out forms or claiming the standard deduction. This is about making proactive, strategic moves all year round, turning your tax prep into like a powerful tool for long-term financial health. Think of it as building your personal tax playbook.
It's absolutely true. What's often overlooked is just how many small, actionable adjustments can create really significant tax savings over time. We're going to explore how your financial decisions, everything from investment choices to charitable giving and even the simple timing of your income, are all interconnected. And understanding that connection, well, that can truly transform your tax picture. This is especially true for the self-employed among you, as we'll see. All right, let's start with a foundational concept. It might seem obvious, but it's surprisingly powerful. Timing. It sounds simple, right? But when you earn income or pay, expenses can dramatically alter your tax bill. What's the core mechanism here? Why is timing such a critical lever?
You've hit on the most crucial point there. The why behind timing is fundamentally our calendar year tax system. Every dollar of income, every deduction, it falls into a specific 12-month window. So if you anticipate being in a lower tax bracket next year, your goal is generally to, defer income into that lower tax year, push it forward. Conversely, if you foresee a higher income year coming up, you might actually want to accelerate income into the current year. Pay the taxes now while you're in a relatively lower bracket. And the exact same logic applies to deductions. You accelerate deductions if you expect higher income this year, or maybe defer them if you think you'll be in a higher bracket next year and get more bang for your buck then.
Okay, so how does this translate into practical moves for us? Let's say someone's right on the cusp, the edge of a higher tax bracket this year. What are some real-world examples? How could they strategically shift things around?
Absolutely. A really common one is asking your employer about a year-end bonus. Can they push the payment into January of the next tax year? Suddenly, that income lands in a whole new tax year, potentially when your overall income might be lower, or maybe the tax brackets themselves have shifted favorably. On the deduction side, if you itemize your deductions, you could make an extra mortgage payment in December, or prepay your property taxes then instead of waiting until January. This effectively boosts your current year's deductions, lowering your taxable income now. We also see people strategically bunching certain expenses, particularly medical ones.
Bunching medical expenses. Okay, break that down for us. What does that mean?
Sure. Bunching basically means consolidating elective medical procedures, or maybe buying necessary glasses, contacts, other deductible health items, all within a single tax year. The aim is to accumulate enough of those expenses in that one year to finally clear the threshold for deducting them. That threshold is based on your adjusted gross income, your AGI. It's 7.5% of AGI, which is actually quite high for many people. So in other years, those same expenses might fall short, and you lose the deduction completely. By bunching them, you essentially create a year where they are deductible.
Ah, that's clever. Consolidating the impact.
Yeah.
Okay, and flipping the script now. What if you're looking at a big income jump next year? What strategic income acceleration moves could you make this year while you're still in a lower bracket?
Exactly the opposite logic applies. If you foresee a significant income spike, maybe you're selling a business, expecting a massive bonus, something like that, you might consider accelerating income into the current lower tax year. A great example is converting a traditional IRA to a Roth IRA. You pay the taxes on that conversion now at your current, potentially lower rate, and then all the future growth in that Roth account is tax-free. And for self-employed individuals or businesses using cash accounting, that means they record income when they receive it and expenses when they pay them. There's even more flexibility. They could choose to invoice clients earlier, maybe in December instead of January, or they could prepay certain deductible expenses before the year ends. Both actions can significantly shift their taxable profit between years. But a quick, important reminder here about the time value of money. Essentially, a dollar today is usually worth more than a dollar tomorrow because of potential earnings or inflation. So you need to make sure any income deferral or acceleration strategy offers a meaningful tax benefit. Don't jump through hoops just to save a tiny amount, or you might actually lose out in the long run.
Right, that makes sense. The benefit has to outweigh the timing shift itself. Okay, so we've explored how strategically timing income and expenses can really alter your tax bill. But this proactive mindset, it extends powerfully to your investment portfolio too. The very act of managing your assets can unlock significant tax savings, especially, it seems, around year-end. One key strategy that comes up constantly is tax loss harvesting. What exactly is that? Why is it so effective?
Tax loss harvesting is, well, it's pretty much what it sounds like. You intentionally sell investments that have dropped in value. You harvest that loss. Now, that realized loss first goes to offset any capital gains you might have realized elsewhere in your portfolio. It can potentially zero out your tax liability on those gains, which is fantastic. And if your losses actually exceed your gains for the year, you can apply up to $3,000 of that excess loss against your ordinary income, your salary, business income, etc. Any loss remaining after that carries over to future years. So it's a way to essentially turn a market dip into a tangible tax advantage.
That sounds like a really powerful way to sort of cushion the blow of market losses. Can you walk us through an example? Make it concrete.
Of course. Let's imagine you sold some successful stocks earlier in the year. You locked in a $10,000 capital gain. You're happy with that, great. But then you look at your portfolio and you notice shares of, let's say, XYZ Corp. They're currently down $8,000 from what you paid. By selling those XYZ shares before the year ends, you realize an $8,000 loss on paper. That loss then directly offsets $8,000 of your $10,000 gain. Poof, you only owe capital gains tax on the remaining $2,000 gain, saving you quite a bit. Now let's change it slightly. What if you didn't have any capital gains this year? That $8,000 loss could still be useful. You could use $3,000 of it to reduce your ordinary taxable income. That could save you hundreds in income tax, depending on your bracket. And the remaining $5,000 loss, it just rolls forward to next year, ready to offset future gains or up to another $3,000 of income then.
That's genuinely impactful, turning a negative into a tax positive. But I've definitely heard there are rules around this. The IRS has something called a wash sale rule. What are the pitfalls here? What do we need to watch out for?
Yes, the wash sale rule. That is absolutely critical to understand, and it's where people can easily stumble if they're not careful. Essentially, it prohibits you from claiming a loss if you buy a substantially identical security within 30 days before or after the sale where you realize the loss. It's a 61-day window in total. The IRS basically wants to prevent you from selling purely for the tax break and then immediately buying back the exact same stock as if nothing happened, gaming the system.
Okay, so you can't just sell Apple at a loss today and buy it right back tomorrow to claim the loss.
Exactly right. You can't do that. However, there are ways around it. You can buy a different stock, maybe one in the same sector, if you want similar exposure. So sell Apple, buy Microsoft, perhaps, or you can simply wait 31 days after the sale before you repurchase the original stock, Apple in this case. That avoids the wash sale rule entirely. It's a powerful tool, especially in volatile or down markets, but it absolutely requires careful execution and good record keeping to avoid tripping over that rule.
Got it. So the IRS is definitely keeping an eye on those quick flip-flops just for tax breaks. Good to know. And it's not just about minimizing losses, right? The timing of your gains matters too. This brings us to another really critical aspect. How long you actually hold on to an investment before selling.
Precisely. This distinction is paramount in the tax code. Assets held for more than 1 year generate what are called long-term capital gains. These gains are taxed at preferential rates, much lower rates. Depending on your overall taxable income, the rate could be 0%, 15%, or 20%. Compare that to short-term capital gains, which come from assets held for a year or less. Those are taxed at your ordinary income tax rate, the same rate as your salary. That rate is typically much higher. We're often talking 22%, 24%, 32%, or even more, compared to the 15% long-term rate for most people. This difference alone can mean thousands of dollars in tax saved or spent.
Wow, that's a huge difference. So, okay, let's take someone, call her Katie. Maybe she's in the 24% ordinary income bracket. If she sells a stock for a profit after holding it for just 6 months, that gain could be taxed at her full 24% rate. But if she just waits, holds on a few more months until she crosses that 1-year mark, that same gain could potentially be taxed at only 15%. That's a significant saving just for being a bit patient. But our sources also hinted at something even more surprising within these capital gains rules. What's one of the most sort of unexpected ways people can leverage this?
Absolutely, and this is where it gets really strategic, potentially saving you even more. It's the existence of the 0% long-term capital gains bracket. Imagine actively planning to realize some investment income without paying a single dime in federal taxes on it. It's possible. If your total taxable income falls below a certain threshold for 2023, it was around $44,000 for a single filer, double that for married filing jointly, you can actually realize long-term capital gains completely tax-free, up to the point where your income hits that threshold.
0% tax.
0%. This completely changes how you might think about selling investments during lower income years. Maybe you're in early retirement or between jobs or taking a sabbatical. You can strategically fill up that 0% bracket by selling just enough of your appreciated long-term assets to use up that space without triggering any tax. It's a powerful planning tool that's, frankly, often overlooked.
That's a really profound insight. Strategically harvesting gains in a low-income year to hit that 0% rate. That's a true golden nugget right there. Okay, so we've looked at these year-to-year adjustments, the timing, the investment moves, but what about the longer game? Beyond these annual tweaks, our sources really delve into strategies that help build your financial future and even let you give back effectively, all while optimizing your taxes.
Indeed. And one of the simplest, yet honestly most effective long-term tax moves is maximizing your contributions to pre-tax retirement accounts. Think traditional 401k or traditional IRAs. Every single dollar you put into these accounts directly reduces your taxable income in the current year. It's an immediate tax break. Plus, of course, if your employer offers a 401k match, well, that's essentially free money. You absolutely don't want to leave that on the table. It's a guaranteed return on your investment. For 2025, you should really aim for those full contribution limits. If you can, something like $23,500 for a 401k, maybe $7,000 for an IRA, depending on age and income limits, of course. And don't forget health savings accounts, HSAs. If you have access to one through a high deductible health plan, they are amazing. Triple tax advantage, tax deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Plus, after age 65, you can pull money out for any reason, just paying ordinary income tax like a traditional IRA. So they double as a fantastic retirement savings vehicle, too.
And it's not just about setting up those contributions initially, right? The sources point out there are critical year-end opportunities as well.
That's absolutely right. You can often boost your final 401k contributions from your last few paychecks of the year if you haven't hit the max yet. Or here's a key one. You can make an IRA contribution for the prior tax year right up until the tax filing deadline, usually mid-April, so you get extra time there. Even a year-end bonus, like we talked about with timing, can often be strategically directed straight into your 401k to shield it from immediate taxation. And for higher earners who are already maxing out these traditional pre-tax accounts, there are even more advanced options, things like mega backdoor Roth strategies. These involve making after-tax contributions to your 401k if your plan allows it, and then converting those amounts to a Roth account, securing future tax-free growth on that money. It's complex, but powerful.
Okay, so we're building our own financial future with these retirement strategies, lowering our taxes along the way. That's great. But what if you also want to be generous? Charitable giving is, of course, wonderful in itself, but the sources show there are some incredibly smart ways to maximize the tax benefit of your donations, too.
Absolutely. Beyond the bunching strategy we mentioned earlier, grouping several years' worth of donations into 1 year to exceed the standard deduction, one of the most powerful techniques involves donating appreciated assets. We're talking about things like stocks or mutual funds that you've owned for more than a year and have gone up in value. Instead of selling them and donating the cash, you donate the asset directly to the charity. When you do this, you generally get a tax deduction for the full fair market value of the asset on the day you donate it. And, crucially, you completely avoid paying any capital gains tax on the appreciation. It's a fantastic double benefit.
Wow. Okay, so let's really drive that home. Say I bought some stock for $1,000 way back when, and now it's magically worth $5,000. If I donate that stock directly to my favorite charity, I get a $5,000 tax deduction, assuming I itemize and meet other rules.
Yeah.
And that $4,000 gain, the difference for the concave and $5, I pay absolutely no capital gains tax on that.
Exactly.
Whereas if I sold the stock first for $5,000, I'd owe capital gains tax on the $4,000 gain, and then I'd donate the remaining cash, getting the deduction but having paid the tax. Donating the stock directly is way better.
It truly is impactful, especially for assets with significant appreciation. Now, for individuals aged 70 and a half or older, there's another excellent tool, the Qualified Charitable Distribution, or QCD. This allows you to transfer up to $100,000 per year directly from your traditional IRA to a qualified charity. This distribution can count towards fulfilling your required minimum distribution, or RMD, for the year. But here's the key. The amount transferred via QCD is not included in your taxable income for the year. It's an above-the-line exclusion. This makes it incredibly beneficial, especially for people who don't itemize deductions or for those who want to keep their adjusted gross income, their AGI, low for other reasons like Medicare premium calculations.
So it reduces your RMD and your taxable income.
Precisely. And one more tool for larger donations, a donor-advised fund, or DAF. This lets you contribute a significant lump sum, perhaps cash, or better yet, those appreciated assets we discussed into the fund in 1 year. You get a large tax deduction in that high income year. Then over time, even across multiple years, you can recommend grants from that fund to the specific charities you want to support. It offers great flexibility in timing both your deduction and your actual giving. Very useful if you have a windfall year.
That's a fantastic range of options for making your generosity even more impactful tax-wise.
Hmm.
Okay, let's shift gears a bit. For many of you out there listening, the self-employed, freelancers, contractors, maybe you're running a side gig, you face a whole different layer of tax responsibilities. It can feel daunting. But crucially, as our sources highlight, you also have some incredible opportunities for savings that regular W-2 employees just don't get access to. So let's dive into what's unique and powerful for you folks.
Right, this segment is packed with potential savings. One immediate advantage for anyone working for themselves is the sheer number of legitimate business deductions you can claim. We're talking things like a dedicated home office space, if it's used exclusively and regularly for business, a portion of your phone and internet bills, necessary equipment, software, supplies, business-related travel, vehicle mileage using the standard rate or actual expenses, even professional services paying an accountant, a lawyer for business matters. Every single dollar of legitimate business expense directly reduces your taxable profit. That can save you easily 30, 40, even 50 cents on the dollar when you factor in both income tax and self-employment tax. The absolute key here, of course, is meticulous record keeping. Keep those receipts, track those miles. The IRS definitely wants proof if they ask.
Good advice. And while you might not have that employer 401k, the sources reveal you have access to some incredibly powerful retirement plans that are tailor-made for the self-employed, right?
Indeed. Plans like the Solo 401k and the SEP IRA are fantastic tools. They often allow for much higher contribution limits than standard IRAs because you can contribute both as the employee and as the employer. So, for example, a sole proprietor netting, say, $100,000 in profit for 2025 could potentially stash away over $40,000 into one of these retirement accounts. That contribution dramatically lowers your current taxable income, providing that immediate tax break, while simultaneously building a really substantial nest egg for the future. The solo 401k is often considered the most flexible, as it generally allows for Roth contributions too if you prefer tax-free growth and withdrawals in retirement, plus potentially higher employee contribution limits.
Wow, over $40,000 on a 100-dial profit. That's significant. But it's also crucial, isn't it, for self-employed individuals to remember that other tax they face, the self-employment tax.
Yes, absolutely critical. Self-employment tax covers your contributions to Social Security and Medicare, the equivalent of what both the employee and employer pay in a traditional job. It comes in at about 15.3% on the vast majority of your net business profit. It's a big chunk, and it's on top of your regular income tax.
Ouch. So how do you manage that?
Well, because no employer is withholding taxes from your paychecks, you're generally required to make quarterly estimated tax payments throughout the year to cover both your income tax and that self-employment tax liability. Miss these, and you could face penalties. Now, here's a useful trick. If you, or perhaps your spouse, also has a regular W-2 job with withholding, you can often adjust the withholding on that job to cover the extra tax liability from your self-employment income. Increase the W-2 withholding enough, and you might be able to avoid making separate quarterly payments altogether. It's just a more convenient way to handle it for some. But effective planning really starts with projecting your income as accurately as possible throughout the year. That allows you to estimate those tax liabilities and set money aside accordingly.
Okay, that makes sense. And beyond all these deductions in the retirement plans, there's one more special deduction that many self-employed individuals and small businesses might be able to take advantage of. The qualified business income, or QBI deduction. Can you tell us about that?
The QBI deduction. Yes, this was a major part of recent tax changes, and it's a huge potential advantage. It potentially allows many pass-through businesses, sole proprietorships, partnerships, S-corp, LLCs, and freelancers to deduct up to 20% of their qualified business profit right off the top. And this deduction is in addition to all your other regular business expenses.
20%, just gone.
Potentially, yes. So, for instance, if your LLC consulting business nets $80,000 after all expenses, you might qualify for an extra $16,000 deduction, 20% of $80K. That means you'd only pay income tax on $64,000 of that profit, not the full $80,000. Now, there are income limitations and some rules get complicated, especially for higher earners or those in certain specified service trades or businesses. But for a large number of self-employed people, it's a very significant tax break that shouldn't be overlooked.
Okay, what's truly illuminating, I think, is seeing how all these different strategies can combine for someone.
Our sources had this great example of Steve, a freelance graphic designer. He earns $60,000. First, he deducts his legitimate business expenses, maybe a new laptop, software subscriptions, his home office expenses, business mileage, let's say, that brings his net profit down to around $54,345. Then, he smartly contributes $10,000 to a SEP IRA. That reduces his taxable income further down to about $44,345. And on top of all that, because his income and business type qualify, he gets that QDI deduction. At 20% of his adjusted profit, that could be roughly another $8,869 deduction. When you add all that up, the business expenses, the retirement contribution, the QBI deduction, these combined strategies easily save Steve several $1,000s in taxes compared to if he hadn't done any planning. It just shows the incredible power of being proactive.
That example perfectly illustrates the main takeaway really for anyone self-employed. You have to treat tax planning as an integral part of your business finances all year round. It's not just an annoying chore come April. Keep excellent records. I can't stress that enough. Set aside money consistently for your estimated tax obligations so you're not caught short. And actively leverage every legitimate deduction and retirement plan available to you. And honestly, for many, considering professional help, maybe from a CPA or an enrolled agent, even just for an annual check-in or planning session can pay for itself many times over, both an actual tax dollar saved and just, peace of mind.
So, wow. We've really unpacked a lot today, haven't we? I think it's crystal clear that effective tax planning isn't about finding one single magic wallet. It's really about the cumulative effect, the synergy of combining several of these smart strategies together. It boils down to being proactive, making informed moves throughout the entire year, not just scrambling frantically in April. Imagine that married couple we hinted at earlier. Maybe in December, they managed to defer one spouse's bonus into January. They bunch 2 years' worth of charitable donations. They harvest some investment losses to offset gains. They max out their 401k contributions. And they prepay their property taxes. Taking together all those moves, made strategically in just the last month or two of the year, could substantially cut their tax bill in a single stroke. It's powerful stuff.
Foresight is undoubtedly your most powerful tool in this whole process. Our sources consistently suggest doing some kind of projected tax calculation in the fall, maybe September or October. This just means taking an educated guess at your year-end income, your likely deductions, and seeing where you stand. It helps you identify potential opportunities or problems before the year actually ends. This allows you to take concrete actions in those final crucial months, like the examples you just gave, to optimize your tax situation and avoid any unwelcome surprises come filing time. Tax planning really is an ongoing year-round process, not just a seasonal chore.
Lovely. And by staying organized, by being proactive, you can legally, ethically pay less tax and keep more of your own income working towards your goals, whatever those might be. So here's something to think about as we wrap up. From everything we've discussed today, the timing, the investments, retirement, charity, self-employment strategies, what single tax planning move could you realistically implement before the end of this year that might make the biggest positive difference for your own financial future? Thank you so much for joining us on this deep dive into tax optimization strategies. We really hope this has given you a powerful shortcut to feeling well-informed and ready to tackle your tax planning with new confidence. Until next time, keep digging for those nuggets of knowledge.